Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, the $500 billion Stargate AI project announced last week was just the most recent in a boom of spending. And while the tens of billions spent by hyperscalers like Meta, Alphabet, and Amazon may not come through with profits anytime soon, there are stocks that are going to see massive growth over the next year. I'm going to highlight how to invest in the AI data center boom, along with 10 stocks I'm buying right now, and important updates to shares of SMCI, Rivian, and the stocks I'm watching this week. First though, we don't talk much about technical analysis here on the channel, but it's an indispensable tool I use to find exactly the right time to buy stocks I like. That's why I'm relaunching my technical analysis and trading course with a 38% discount, save $150 off. The complete course includes more than 30 videos on how professional investors trade stocks and the technical analysis they use. You'll also get the bonus material on fundamental analysis, trade examples, and trading worksheets to follow your trades. Click through the link I'll leave in the description and check it out with a free preview or try it risk-free for 14 days. You're going to learn how to find stock trades and never run out of ideas, how to identify price changes before they happen, and the top trading patterns used by professional traders. That 38% discount is only good with the special coupon in the link below, so check that out. Back to our main topic here, and last week's $500 billion AI data center announcement was just the latest in that long list of capital investments in the theme. Now, besides the Oracle OpenAI Softbank partnership, Meta announced last week that it would be investing $60 billion in AI this year, and just the 5 major hyperscalers are expected to invest upwards of $1 trillion through 2027. Now, data centers are the middleman of the tech world. If you're on the net, streaming Netflix, or asking AI to watch your kids for you, then you're going through a data center. So as AI and our online lives grows, so does that data center demand. Now, there is a question whether all this spending is going to come through in earnings growth, but one thing is undeniable. It's going to mean a bonanza for companies supplying hardware and software to that data center buildout. In that opportunity, I want to focus on the higher level infrastructure needs, the 5 critical components within a data center, and then the stocks within that to watch. And first tier servers are the workhorses of the data center, storing and processing all that traffic in and out. So it's here that's gotten the most attention from investors. Now I like Supermicrocomputer, ticker SMCI, as a pure play on that theme, with its modular designs that enable users to customize and change out components. Now, of course, there is higher risk in SMCI, with just a month left to file its late reports and avoid a delisting from the Nasdaq. But as I pointed out on the channel, the short seller allegations are bunk, and this is just the best deal in the theme. Now, I've been buying over the last 3 months and now hold 17,000 shares. Less risky though, but not the pure play in that server space, are Dell Technologies, ticker DELL, and HP Enterprise, ticker HPE. Now, while valuation for Dell is the lowest at just 0.88 times on a price to sales ratio, the company is still struggling under other segments, especially with a slowdown in laptop demand. I like HPE as well at just 1.08 times on that price to sales valuation, and a strong player in several of these data center themes. Storage is another critical component within a data center, with players in direct attached, network attached, and storage area networks. The storage area networks are generally the best for AI on its high-speed connectivity and low latency, so focus on those providers for this build-out. Here we also see Dell and HP as players in the space, but also Broadcom, ticker AVGO, with its high-performance storage area network solution Brocade, along with Pure Storage, PSTG, and NetApp, ticker NTAP, specializing in that AI-ready storage through its E-Series. Next, networking equipment allows the connectivity and the data flow between storage and servers, and could be the next big bottleneck in that AI theme. As AI workloads scale up and data centers push towards exascale computing, you also need a step-level change in networking for the low latency and the performance that those models need. Here, Broadcom is also a player on the list, but my favorites include Cisco Systems, ticker CSCO, on its experience in the theme and just low valuation, along with Arista Networks, ticker ANET, on its AI-driven focus for cloud networking. And now if you're on a laptop, feel the back of your computer. Now imagine thousands of those all in one room. All that hardware gets hot, and cooling is critical to performance. Vertiv Holdings, ticker VRT, is as close to a pure play here for its power and thermal management solutions, and is expanding its capabilities through acquisitions. But I also like SMCI here, designing its systems to run more efficiently and be cooled easier. Now, all this electronic magic needs power, and it's going to have to be dependable and uninterruptible. Vertiv Holdings also specializes here with its uninterruptible power supply systems and PDU. Bloom Energy, ticker BE, also offers its solid oxide fuel cell technology that provides on-site power and is also worth a look. Now looking at the stocks I'm watching this week, Rivian Automotive's ticker RIVN continues to shore up its finances with new partnerships. First, the company signed a partnership with Volkswagen in November that would see the German automaker invest up to $5.8 billion to jointly develop software technology and Rivian's existing electrical architecture. More recently, the CEO said that the hands-free system would be ready this year and an eyes-off Level 3 technology by next year. Then Friday, and this is what had me buying more shares last week, Rivian confirmed that the other automakers were interested in licensing that software and electrical architecture developed under the VW partnership. I know there's a lot of Tesla absolutists out there, and the company still dominates that EV market, but Rivian is continuously showing that it has the potential to carve out a niche in that truck market. The company is expected to post about 15% sales growth this year to $5.2 billion and has a solid cash position, though even I'll admit the cash flow statement here is pretty fugly. Higher production though, and that VW deal is helping it bring costs down fast, and at a price of just 2.7 times sales, if it can ramp up production to that point of efficiency like Tesla did back in 2017, this will be the stock you wish you had bought. Also here, US dollar strength broke last week after President Trump held off on big tariff threats and tried to talk down interest rates. The US dollar index bullish fund, ticker UUP, fell 2% on the week, but the dollar is still trading at multi-decade highs versus other major currencies. Fears of higher inflation and some of the policies in the new administration are driving up interest rates and limiting those expectations for Fed rate cuts this year. Understand that a higher interest rate pulls foreign investment into the US, which pushes the value of the dollar higher, but I've started taking the other side on this, that the dollar is overvalued and ready to fall here. I made just over $5,000 in the last week buying futures contracts on the other currencies. That was about $3,700 on the Aussie dollar and the yen against the greenback, and a position on the euros that netted me $1,662 when it closed out on Friday. A simpler and less risky strategy would be to buy put options on the UUP dollar fund, which holds the dollar against a basket of currencies. Here, a long list of catalysts could shake the dollar lower over the next couple of months, including lower inflation reports, difficulty of raising the debt ceilings or passing any bills within the partisan Congress, or just President Trump further trying to talk down the dollar and interest rates lower, both of which would be better for the economy and exports. Super Microcomputer, ticker SMCI, is fast approaching that February 25th deadline to file its late financial reports and avoid that delisting from the Nasdaq exchange. Shares are up 97% from the November low on an internal investigation that found no wrongdoing and the hiring of a new auditor, but are still 70% from that March peak of $122 a share. I continue to hold those 17,000 shares on the belief that they will file in time, but there's still some risk that they miss that deadline. Shares are easily worth $40 to $60 each once they file, and back as high as $100 a share on the company's pure play advantage in that data center hardware theme. With that deadline approaching though, the February 21st call options would likely give you that upside if the company does meet its deadline. In that case, the shares would jump well past $40 or even $50 a share, making the call options very profitable. For example, if the shares jump to $50 each, those $40 strike call options would have an intrinsic value of $10, slightly more for the time value. Selling those options back for say $12 each would be a 370% return in a month on the current $2.55 premium. Please understand though, this would be more risky than just holding the shares, because here you could lose that entire $2.55 per share on those options, but it may just be a case where we know the catalyst is coming and it's worth the risk. Thinking about some of the stocks I'm watching this week, I posted in our private Facebook group last week asking what stocks you're watching, and the Bowtie Nation came through big time. I put AMD, Ally, and SMCI on my watch list for valuation and would add SYM for a growth pick as well. And now Rivian on that recent news. Here, longtime citizen of the nation, Amy. Well, hell, Amy is at least a governor at this point, as long as she's been in the Bowtie Nation, but she remarked how she's just sitting on some of her penny stocks, but not buying any more right now. And I can relate. I was researching for a video on penny stocks under $5 last week, and couldn't even find enough good value picks to make a video. Anders here is adding Pfizer on valuation, and Justin is right there in SMCI. Philip is following the last year's money in energy names like KMI and Energy Transfer. And Chad over at Lifters Gym in Albemarle, that's probably Vice President Chad, who pretty much runs our Facebook group at this point. He had a list that's too long to go through, so I'll just link to it in the description below. Giving you that bigger picture idea here with the Sector Spider Sector Tracker. 10 of the 11 stock sectors closed higher last week, with only energy following on the drop in price of crude. With sluggish global demand and President Trump's focus on increased production and lower prices, the upside to energy stocks may be limited through the next few months. The technology and communication services stocks regained their leadership on optimism for that AI growth theme. We're nearly a month into 2025, and we're seeing broad strength across the market with the sole exception in consumer staples and discretionary stocks. This strength across the rest of the market is a positive, but watch reported earnings and the outlook for those retailers over the next few weeks for kind of a gauge on that consumer health. If that weakness in consumer stocks turns out to be a prelude to everything else, with consumers powering more than 2/3 of the economy, could start to weigh on the overall stock market. It is going to be a very busy week for news and stocks, first with earnings season in full swing, then the January 29th Fed meeting on Wednesday, and Friday's report on the personal consumption expenditures, that PCE measure of inflation. Chair Powell and the Fed wraps up its meeting on Wednesday with the Fed Watch rate tool now predicting 99% odds of no rate cut, up from 92% last month, and a huge change from last year's expectations for more rate cuts. Those fewer rate cuts are being driven on a string of stubbornly high inflation reports and fears that new policies like deportations and tariffs are going to stoke more inflation. The market is now pricing in just one cut in May and nothing else for the rest of the year, pretty much the worst case scenario that I think is overdone at this point. Any moderation in inflation or a further delay in those hardline tariffs is going to improve the outlook and bring more rate cuts back to the table, boosting stocks. We'll get a clue into all of that with the personal consumption expenditures, that PCE report of inflation on Friday. Expectations are for price pressures to have ticked up a little bit to 2.6% in the year through December versus just 2.4% pace reported last month. Now, the most recent CPI measure reported earlier this month shows a better trend, so I'm hopeful the PCE confirms this with a positive surprise on Friday. But the big news and the biggest opportunity this week is going to be in earnings. It's a big week with 102 companies in the S&P 500 reporting, and so far Q4 profits are looking very good at 12.7% growth over the last year, which is the best growth since Q4 of 2021. Of the 80 S&P 500 companies reporting so far, the outlook commentary has also been good, helping to keep stocks moving higher. But then the opportunity here, something I wanted to point out because it doesn't appear to be priced into the market yet, is in healthcare stocks, specifically in pharmaceuticals. If we look at expectations for Q4 earnings, so earnings from last quarter, healthcare is nothing special at 11.6% growth and under the market average. And we've seen that lackluster growth in stocks with the sector up just 2.9% last year, the worst performing sector in the market. But now look at expectations for the next quarter, with stocks in the sector seen posting blowout earnings growth of 40% and 20% for the full year, the second best sector for profit growth. Looking at valuations, stocks in the healthcare sector are some of the few still trading attractively. The sector is trading at a price of 17.4 times expected earnings. That's just 6% over the average 16.4 times multiple the sector has traded at over the last 10 years. Now compare that with valuations trading for premiums of 20 and 30% to long-term averages in sectors like consumer discretionary, technology, and industrials. You see how truly cheap the healthcare sector is right now, especially relative to that kind of profit growth accepted. Within the group, pharmaceutical companies are expected to see the lion's share of growth, with earnings up 61% in the next quarter, so be watching for stocks in that industry, like Merck, AbbVie, Pfizer, and others. Get your $150 discount and learn the trading signals and technical analysis pro traders use for exactly when to buy or sell stocks with the special coupon code in the description below. Or click on the video to the right to see the 7 penny stocks I'm buying for 2025. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.